Hey everybody, welcome back to Passive Money. This is Kirby. That's Alex over there. Today I'm going to talk about one of my favorite topics: spread money too thin. Money too thin in investments is the real area that we're looking at. With all that being said, Alex, what is your insights on it?
Yeah, I mean, it's specifically like on in the stock market, it's very crucial because if you have and I see this with many YouTubers where they're sharing their financial journey on the stock market and then they've got like 53 dividend stocks. And it's like, why do you need that many? The truth of the matter is, like we had talked about in another video, I mean, you can just pick three dividend stocks that are good for your portfolio and pay every month. Having 50 plus stocks is just, I mean, say you have 50 grand in there, so you have $1,000 in each stock, but in reality, if you had five stocks and 10 grand in each one, you would see a better return on that than spreading it all over the place. And many of these stocks are in the same sector. And if you want to spread your account out like that, just invest in the S&P 500 or the NASDAQ. I mean, that would be the easiest solution to that.
Right. My question would be, with 53 different stocks, can you really pay attention to and understand and know what all those different stocks are doing?
Exactly. Right. Yeah. It's like a lot of work for sure.
Right. And my view on it is spreading your money too thin does a couple things. So if you have a couple shares and 100 stocks, and then let's say half of the stocks go up 100%, and usually it's the best in breed of each sector. Like you said, a lot of these stocks are in the same sector, but the best in breed goes up 100%, and then the other half does nothing to lose money. You're still roughly at zero. If you're gonna put your money in the stock market, again, like we talked about before, do the homework. If you're gonna invest in the sector, invest in the best in breed in the sector. The best in breed meaning the best company in the sector, no matter if it's tobacco, real estate, transportation, it don't matter. Invest in the best one in the sector. And then with that, with more money means more shares in a stock. So when the stock starts going up, that means there's more money in your account. The same thing with the dividends, like you talked about. If you have more money in the stock, if you have more shares in the stocks, the dividend payments become larger. When you spread it real thin, one, you can't pay attention to all of them. Two is you scrambling to see what's going on and you're always late to the game. And then three, you don't have enough consolidated capital in one place to make a big difference in your portfolio. Um, you might get some pushback on this where people saying, "Oh, well, you spread thin to be diversified." Um, if you're doing the research, then you don't need to be as diversified. Diversified is for people that are C students, people that just, oh, I just don't want to lose money. If you don't want to lose money, then find another game to play, or not necessarily find another game to play, but if you don't want to lose money, why don't you invest in something that historically has beat individual stocks, beat hedge funds, beat mutual funds, and just invest in the S&P 500, like you mentioned. If you just don't want to lose money, if you if you want to diversify in different asset classes. Like you have stocks here, you have real estate over there, you might have a business on one side, you may work it. So that's four different ways to bring in income. But sitting there just buying a whole bunch of stocks just to good. I'll call that good coffee table talk when you hanging out with the friends. Oh yeah, I got 53 stocks. Okay, what does that do? That it really doesn't do nothing. It just make sure it's just a way of people hedging their lack of knowledge about the investment sector at all. So if you're going to be in the game, be in the game, study the companies, getting the best in breed of the companies, and profit the most by consolidating your capital into the best in breeds. There's nothing wrong with having, and I don't believe people should have more than five stocks. Individual investors that's not very focused on the market is concentrate your money into those 3 to 5 stocks, and then let those ride after doing the homework instead of, oh, I'm just going to spread my money all over the place and I'm just going to hope for the best, because that's what they're doing, is hoping for the best, because it's not 53 great companies in the stock market. So I mean, there's some good ones, but there's not 53 great ones. So invest in the great companies, invest in the best in breed in the sectors that you have knowledge about or you want to have knowledge about. And I think you'd be better off in the long term.
Right. And I mean, I remember at one point I was invested in Kronos Group and Altria. And for those that don't know, Altria owns Kronos Group. And you had told me, like, why would you do that? Because you could just invest in Altria. I mean, it's the same thing basically, because they have a 45% stake in Kronos Group. And I mean, it's the same thing with say AT&T, right? They did this spinoff, and AT&T shareholders receive Discovery shares, and you know, changing your mindset on that, on how diversified you want to be, can make you a better investor. Because do you want to, say in that scenario, stick with AT&T, or do you want to stick with Discovery? Because it's, you gotta make those decisions where it makes no sense to invest in one company that's owned by another and then invest in that one too. You just spreading money all over the place.
Right. And people might pivot to, oh, well, Warren Buffett owns a lot of stocks. No, Warren Buffett doesn't. Warren Buffett himself only owns one stock, and that's Berkshire Hathaway. Berkshire Hathaway, they own a lot of stocks, and the reason why they own a lot of stocks is because of regulatory requirements. They can't sit there and own more than 10% of a bank and not consider themselves a bank. So they bring themselves up to that threshold and they own 9.9% of different banks. Of course, when these banks do share repurchases or they buy back shares or things like that, Berkshire Hathaway have to cut their stakes so they're less than 10%. Over 2 quarters, they have to cut it so they're still down there. But they're doing it because of regulatory conditions, like Occidental Petroleum or Berkshire Hathaway petitioned to the SEC to allow them to own 50% of the company without giving a bid to take them out outright. So, but Warren Buffett himself only owned one stock. Companies have to operate at a different frequency than individual investors. So I'm not telling everybody, hey, you're as good as Warren Buffett, only will own one stock. You're not good as Warren Buffett, so maybe 3 to 5, but a lot of the stocks that Warren Buffett has in his portfolio are great quality companies that you can hold over the long term. And contrary to what everybody's saying on the internet, hedge funds, mutual funds, all that things like that, Warren Buffett has been beating the S&P 500 for a long period of time. So you can either invest in Berkshire Hathaway like he does, or you can invest in the S&P 500 and just keep up with the index. But besides that, I wouldn't be sitting there trying to spread myself all over, trying to hope one stock takes off. And then what if that one stock takes off? You have so little money in there that the stock takes off, it still ain't gonna have a big impact to your portfolio. So let's say if you had $10,000 spread over 50 stocks, you might have, I need a calculator because I went to public school, but so
No,
that's $200 per stock. Two
almost.
hundred bucks per stock. So let's say that stock that you got $200 in goes up, let's say 5x. Let's say it goes 5x. That one stock goes up 5x. So now that stock there is $200. Now it's up to $1,000. Is that going to change your life? No. But if you have $10,000 and you have 3 stocks and one of the stocks goes up 5x, it's going to go up, $2,000. That's going to go up to $10,000. So you can double your money. But again, to do that, you have to do the homework over and over again. I will repeat that. Have to do the homework to consolidate a portfolio. But if you're lazy, just invest in S&P 500. You'll be better off in the long run.
Absolutely. Well, guys, if you like this video, leave a comment down below. Hit the like button and subscribe to our channel. And don't forget to share our content with your friends and family. We'll see you guys in the next video.